This is the final video in Fruition Capital's series exploring a sample business acquisition in the ETA space. It is also part 2 of our closer look at equity deal terms. In part 1, we focused on the equity provided by the entrepreneur. In this video, we will highlight typical deal terms for outside investors. We previously discussed the various reasons entrepreneurs can secure majority equity ownership independent of the amount of capital they invest in a deal. However, investing in small business acquisitions is also highly appealing to investors. The main reason for this is that outside capital invests in a share class known as participating preferred, which takes precedence over the entrepreneur's common stock. This structure not only protects investors from downside risks, but also allows for significant upside potential. Preferred equity ranks above common equity in the business hierarchy. Typically, preferred shareholders have a priority right to all excess cash flows after the business makes its debt service payments. Additionally, in a sale or liquidation event, participating preferred shares offer a priority payout. Investors recoup their original investment before common shareholders receive any payouts, effectively safeguarding their capital. In addition to the downside protection afforded by the liquidation preference we just discussed, participating preferred equity offers investors a priority fixed dividend rate. This consistent return reduces downside risk and provides a reliable stream of income. In our example, the preferred dividend return is 10%. An investor like Fruition Capital will receive this dividend rate on all of their outstanding invested capital until it is repaid in full. Participating preferred shares also include an equity step-up. After receiving their entire investment principal and all preferred dividends, these shareholders will participate as common equity holders on a cashless basis moving forward. In today's market, the equity step-up is usually 1.5 to 2 times the investor's percentage of deal capital. In our example, it is 1.8 times, which means Fruition's investment increases from 9.5% of total capital to a 17.1% common equity stake in the business. Outside investors also receive other key benefits. The priority status and potential board seats associated with preferred stock can allow investors to have a more significant role in the company's direction. This share class often comes with voting rights, giving investors a say in crucial decisions, as well as protective provisions to safeguard their interests and maintain control over key company decisions. Overall, as you have seen, participating preferred shares strike a unique balance between security and upside potential, making them a prime choice for outside investors in small business acquisitions. This concludes Fruition Capital's video series on a sample business acquisition in the ETA space. Please be sure to see our other videos explaining this newly emerging investment class.